Let's talk about mortgages in general. I want to teach you about the most common types of mortgages, what makes those mortgages up, and if you stick around to the end of this video, I'm going to show you a really cool website that's going to allow you to determine how much you can afford based on your specific scenario. So let's start with the basics. Let's talk about the 4 factors that make up a home mortgage. You might have heard the acronym PITI, P-I-T-I. What that actually stands for is principal, which is the amount of money you borrow from the bank and pay back on a monthly basis. Interest, which is the money you pay on top of the money for borrowing it to the bank. It's how the bank makes their money. It's interest you're paying on the loan. Taxes, which are going to be your property taxes on the home that you purchased. The property taxes are based on the assessed value of the property. The assessed value is determined by the county where the property is located. And insurance. The insurance could be your homeowner's insurance. That's what protects and will replace your home in the case of a fire or a hurricane here in Florida. It also can include flood insurance, right? It can include PMI, which is private mortgage insurance, which is required on a conventional mortgage when you put less than 20% down, and it's required on FHA mortgages regardless of the down payment. But PITI is a common acronym you're going to hear as you're going through the mortgage process or discussing mortgages in general, maybe with friends, maybe with family. Now, the 7 most common types of mortgages that we see are 1, conventional mortgages, which most conventional mortgages are going to be fixed rate mortgages. A fixed rate mortgage means that the interest rate does not change for the life of the loan. If you had a 30-year fixed rate mortgage, assuming you kept that mortgage, the interest rate will be the same year 1 as it is year 30, right? And there's 10-year, 15-year, 20-year, 30-year. As a matter of fact, there's custom ranges. You can do an 8-year mortgage, a 9-year mortgage, a 13-year mortgage. Whatever works for you and is going to get you the payment you're comfortable with can be offered up to 30 years. There are some 40-year mortgages, but they're not available as conforming or conventional loans. They're typically a little more unique. But the most common type of mortgage that is obtained by a home buyer is a 30-year fixed rate mortgage. And like I said, the interest rate never changes. Now, an adjustable rate mortgage, or an ARM, is a mortgage where the interest rate is fixed for a period of time and then changes after that fixed period of time. Now, most adjustable rate mortgages are 30-year mortgages, but the rate is just not fixed for all 30 years. It might be fixed for the first 5 years or 7 years or 10 years, right? If you want to know more about different types of mortgages, how adjustable rate mortgages work, please make sure to subscribe and check out my video specifically on mortgage types. But an adjustable rate mortgage, as I said, has a rate that will not remain fixed for all the years of the loan. The reason someone would typically go with an adjustable rate mortgage over a fixed rate is in most markets, an adjustable rate is going to be lower than that of a fixed rate. An FHA mortgage, also an extremely popular mortgage type. You might think it's only for first-time home buyers. It's actually not. An FHA mortgage is for the purchase of a primary residence, meaning a residence you're going to live in year-round, but you do not need to be a first-time buyer to use an FHA mortgage. And it's cool as it allows for as low as 3.5% down. Most FHA mortgages are going to be fixed interest rate mortgages. VA mortgages are mortgages that allow for no down payment, also for the purchase of a primary residence, meaning a residence you're going to live in year-round, but you do need to be active duty military, a military veteran, or the spouse of a deceased military veteran. And USDA mortgages. A USDA mortgage is a mortgage on a property that's in a rural area. It allows for no money down. Also needs to be a primary residence, meaning a residence you're going to occupy year-round. Now, those are the most common. Here are 2 more less common mortgage types, but I wanted to at least bring them up because they are part of the 7 most common. A jumbo mortgage. A jumbo mortgage is any mortgage that's greater than the conforming limit for the area where the home is located. Now, every year, Fannie Mae, Freddie Mac, they're going to release what the conforming loan limits are for specific counties. So here in Florida, I'm in Broward County. The new conforming loan limit is $766,200. That means that any loan exceeding that is called a jumbo loan. Now, when you get into jumbo loan financing, the credit requirements are more strict. Reserves can be more strict. Your debt to income ratio could be more strict, right? So jumbo financing is definitely more strict, and it's for higher priced properties. Another option is interest only. Interest only means rather than paying money toward the principal and the interest on loan every single month, like PITI, P-I-T-I, right? It's the P and the I, you're only paying the I, the interest, meaning that you're gonna have a lower monthly payment, but the balance on the mortgage will not change month after month. So those are the most common mortgage types that we see in any market. But what I want to show you is I want to show you how you can determine what's affordable based on your own personal scenario. So there's a really cool tool on the Freddie Mac website, and I'll share the link in the video description below so you can check this out for yourself. But I'm going to walk you through a couple of scenarios that you can easily do on your own to determine your affordability. Now, we're not talking about what you qualify for, what a lender would qualify you for. We're talking about what you feel you could afford and what's comfortable, because everyone is a different situation. What you can afford is not necessarily what you qualify for, and vice versa. So let's walk through a simple scenario here using this home budget calculator on the Freddie Mac website. So first we're going to click on this tab for loan borrower info. Now we're going to base this first scenario on income. Now it's asking you to enter your annual gross income. We as lenders are going to use your gross income, meaning your income before taxes are deducted, unless you're self-employed, of course. But let's just say you're a wage earner, you're a W-2 employee of a business that you have zero ownership in. We're going to use your gross income. So let's just make up a number for right now just to run these figures. Let's just say, jumped up a little bit. Let's just say you make $70,000 per year. And now we want to factor in any other debt you might have. Now, maybe you're lucky you have no debt, but we're not concerned with the balances necessarily when trying to do the budget. We're concerned with the minimum monthly payments. So when it wants to know your monthly debt payments, it's all it wants to know, the minimum monthly payments. So maybe you have a car payment, some credit cards, whatever it might be. So let's call that number $700 a month. You have $700 a month in existing debt. Now, how much money have you set aside to use toward a down payment on a property? You might have no money set aside right now, but let's assume you have something, right? So you set aside $30,000 to use toward your home purchase. You're going to want a 30-year mortgage. That's where the 30, you can toggle this back and forth, go with shorter terms, longer terms, whatever it is, but set it to 30. That's going to be the most affordable payment you can get on a mortgage. And then of course you need to set an interest rate. So let's just say it's somewhere around today's rates, which are in the high 6s, low 7s. So let's get to a 7% interest rate. Now, you're also going to have taxes and insurance, TI, in the PITI, right? We talked about that. So let's talk about what that's going to be. So we want to include the taxes and insurance in the payment. So I have the include tab checked here. And then we're going to put property taxes. So let's just say that property taxes are $4,800 a year. Depending on where you buy, it's going to vary, of course. And let's just say that your insurance on the property annually, you're buying in Central Florida, maybe $1,600 per year. Now, no HOA fee, so no homeowners association. Now, assumptions, debt to income ratio. How much of your income that we're using do you want it to consider toward this calculation? So lenders maximum on a conventional mortgage is going to be 50%. So let's just set that 50% and 50%. All right. So based on the information that we've entered, right? We said you made $70,001 per year. You have existing monthly debts of $700 a month. You have $30,000 for a down payment. You're going to get a 30-year mortgage at a 7% interest rate on a property with $4,800 a year in taxes, $1,600 a year in insurance, and we're going to consider 50% debt to income ratio, monthly gross income compared to expenses, including the new property. Based on that, this is telling you that you can afford a home up to $260,719 with a total monthly payment of $2,217, which is broken down right here. So it knows you're putting less than 20% down. And because you're putting less than 20% down, you're going to have mortgage insurance, which is the $148. So we see that you're $1,535 in principal and interest, PI, taxes of $400, T, homeowners insurance and mortgage insurance, I. So PITI equals $2,217 per month. Now, you might not be comfortable paying that amount per month, but this is at least telling you, based on the information entered, that's what you should be able to afford when you speak to a lender. Now, maybe you want to work this backwards. Maybe you don't want to just base this on your income. You want to say, what can I afford what am I going to be able to afford as far as a purchase price is concerned if I have a set monthly payment in mind? Okay, you can work it that way too. Instead of income, you can change the calculation to payment. And you can say, maybe you're paying $3,600 a month in rent. You don't want your mortgage payment to be more than $3,600 per month. In this scenario, you have $60,000 to put down. It's going to be a 30-year mortgage again. Let's just say the rate's 7.2%. Once again, let's just leave the same taxes, same insurance in here. We're going to include them in the payment. And now for that scenario, it's telling you that if you want a $3,600 a month maximum payment, that you can buy a home for $472,666. It's going to be a $3,600 payment. Here's how it breaks down. Once again, assuming you're putting less than 20% down, which you are. $60,000 is less than $472 and 20% of $472, which is why there's mortgage insurance. So here's your PITI payment, just like before, $3,600 a month, right where you said you wanted to be. So this is a really cool tool to show you some affordability without you necessarily having to speak with a lender first. You might want to start here, get an idea of what you might be looking at, and then have the confidence to speak to a lender once you're comfortable knowing what you could potentially expect as far as a purchase price is concerned. Now, once you speak to a lender, they're going to run the real numbers, they're going to help you out, they're going to really guide you properly, but this is a great idea of a place to start to get a baseline of what you should be looking at. You can also check the amortization of these mortgages. The amortization schedule is going to show you the breakdown of the payments over the term of the loan. And it's going to show you how much money goes toward principal, how much money goes toward interest in each month from month 1 all the way through month 360 on a 30-year mortgage. If you went with a shorter term, of course, this would be shorter. But it just shows you how that breaks down. Maybe you want to do a comparison at different interest rates to see how much money you're going to owe at a certain period of time into the mortgage, right? Maybe you want to know where you're going to be 10 years in to the mortgage as far as the principal balance is concerned if your rate was a 6.5 versus a 7.5, right? So let's do that comparison. Let's say this is your scenario, same rates. So let's just say that the interest rate was 6.1%, and you want to see the amortization schedule on that, and you say, okay, what's my balance going to be at month 120, right? 10 years in. So it's right here at the top. Balance, $383,961, right? So it's easy to check that. It's easy to know what you're going to be looking at any given time or any point in time during the loan. So definitely educate yourself. Make sure to check this website out. It's really user-friendly, probably easier for you on a computer. I'm trying to work it here off my iPad, so it's a little bit finicky. But like I said, I'll provide the link in the video description below so you can play with this, check it out for yourself. If you have any questions about mortgages, home affordability, make sure to put those comments below. I do respond to 100% of the comments that are made on my channel. And make sure to subscribe for more videos with helpful information on mortgages and real estate, just like this one.